Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. Can't wait to get stuck in with you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We're going to cover the news that is moving markets. We're going to talk about resilience when it comes to investing. And finally, somewhat nervously, very apprehensively, you and the Facebook discussion group that we have somehow convinced me to share my portfolio. Don't know how I'm doing it and you're not, but that's what we're going to close out today's episode with.
Yeah, so stick around for the big portfolio reveal for Ren's portfolio. But as always, let's start with news and markets.
News and markets.
All right, well, Bryce, before we get into the news that is moving markets, you've got some news on things that are moving in your portfolio.
Yes, yeah. A bit of an update on something that I've bought in recent days, and that is mineral resources.
Nice.
Yeah, so it's been on the watch list for a while.
It's down, what, like 70%?
I think it's down 45% year to date.
Okay.
Yeah, so it's taken a serious tumble. It's been on my watch list for a long time, given how a lot of our experts on the show talk about it. High quality company, you know, led by an amazing founder, and just a company that continues to underpromise and overdeliver. And it's really taken a tumble, and it's been tied to the fortune of the lithium price this year. However, boldly they came out last week and said that the lithium price has bottomed.
Okay, I'm just looking at its chart. So it was down about 65%, but then it's bounced about 25% in the last week.
Yep. Well, because last week they came out and said the lithium price has bottomed.
Okay.
Their reasoning for this was a major producer over in China of lithium. There's unconfirmed reports that it's shut down, unconfirmed from China, but globally many people are like, we know it's shut down.
A lithium processor?
Yep. And so they reckon that a huge chunk of supply is now coming out of the market. And so they think this is the bottom because everyone's closing down at the moment. No one can survive on the lithium price as it is at the moment.
Yeah.
They reckon this is the bottom. Now, opportunistic buy. But for me as well, down 45%, I figured it's a company that I've wanted to own for a while. Their mining services business is still going strong, and I've taken it as a chance to get in. So I've put it as about a 2% positioning in the portfolio. I want to get it up to about 5.
Yep.
But I'm going to see how it, because as you said, it bumped after the news came out last week. Lithium price went up a little bit as well, but who knows where to from here.
Yeah, well, that's an interesting one. Obviously, this is just Bryce's portfolio moves. It's not a buy, hold, or sell recommendation. But let's keep moving with the news. And I think the headline that is emerging that we kind of have spoken about for months and that we knew was going to come, and the day has finally arrived. Australia is out of sync with the rest of the world.
Yes. Now, what you mean by that is when it comes to our interest rate movements.
Yeah, well, and inflation. I think importantly.
Yes.
So while the rest of the world perhaps moved more aggressively and moved faster on raising interest rates and really fighting inflation, Australia perhaps moved a little slower, didn't raise as much. And now we're seeing the result of that is that Australian inflation still is a little bit sticky, floating around that high 3s and 4% a year, whereas a lot of other countries have got it back under 3% and have given themselves the capacity to cut.
Yes.
So a quick around the grounds. The European Central Bank cut for the second time in 3 months. The UK cut in August. Canada has actually cut 3 times already, their latest being this month. New Zealand cut in August for the first time, and the United States is going to cut this week. It's all but guaranteed. The question is really just how much. Australia, on the other hand, doesn't look like it's going to cut interest rates this year.
No, absolutely not. There was talk a couple of months ago that they were even going to increase, but yeah, definitely out of sync. We've spoken on the show what impact that is going to have on the Aussie dollar, Ren, as all of these countries start cutting and we're staying where we are. You would imagine, well, it already is impacting the price of the Aussie dollar.
Yeah, in theory, that people can get a better rate of return from their money in Aussie dollars than in other currencies. And so people will move to Aussie dollars, which will strengthen the currency. But look, it's one of those things, it's like, we've spoken about interest rates and inflation a lot, and it's just going to get even politically harder now when we look out at the rest of the world and their cutting rates in Australia perhaps is going to need to raise or at least hold for a little while. So I think, we already have seen the Treasurer and the RBA Governor subtweeting each other in the media, blaming each other for the state of the economy. We've seen recommendations to the RBA's board structure basically fall away. The opposition have not given their support. The Greens have put conditions on it that probably won't be tenable for Labor. So it's like, we're out of sync. It's become a political football. It's just not a good setup at the moment for like long-term, proper debate and structural reform.
Yes, yeah. It could get quite messy, which is concerning for us. Messier. Yeah. We could get in a fair bit of trouble. But anyway, we'll see how it pans out. Time of recording, we are anticipating how much the US cuts, but let's move on. OpenAI, Ren, a pretty big announcement in the development of their AI capabilities.
Yes. Well, I mean, we seem to get a lot of big announcements that we don't really understand. New model does this, new model does that. So here's their latest model, O1.
Yeah.
It can operate at a PhD level of maths and science.
Yeah. Pretty amazing.
Yeah.
Well, I wonder what it's operating at now, though, because whatever I'm throwing into OpenAI, it seems to be managing it pretty well. GPT-4, it's phenomenal.
Yeah, well,
phenomenal.
I think a big build this one is it takes more time to think. So you won't get the answers as quickly, apparently. But that's perhaps not the worst thing.
Fine. I don't think I'm after OpenAI to spit out at its speed. You just want the best answer possible. Yeah.
It is just like this ongoing march. Like more and more applications will come as it gets more and more sophisticated.
Yes, it's getting closer and closer to not artificial intelligence, but
general. Artificial general intelligence, AGI.
Yeah.
We don't know if it's getting closer and closer.
It feels like that.
It's still arguably just like pattern matching and formulaic, and it gets taught so much data and it just can accurately predict what the next thing is.
Yeah.
Anyway, we're not here to talk about the complexities of AI because it is not in our circle of competence. What is in our circle of competence is the business side of this story, and the OpenAI business story is pretty amazing. So they're in talks with the UAE-backed fund, the United Arab Emirates, to raise money at a $150 billion valuation. Now, to put that in perspective, that'll be like right at the tippy top of private companies. You're talking the SpaceX's, the ByteDance, which owns TikTok, and Stripe. But it'll be big. They all sort of sat around the $100 billion in 2021. Some of them have had their valuations cut. So this is massive. But what is even more impressive is the rate of growth. So 150 billion now, it raised at 86 billion last year. And that 86 billion was 3 times the valuation it raised at just earlier that year.
Yeah.
So in about 18 months, it's gone from about $30 billion valuation to $150 billion valuation.
Off $4 billion annualized revenue. Yeah. Which is also growing incredibly quickly. I think it was up 580% year on year.
Yeah.
So unbelievable story. Yes. I'd love to invest.
One of the conditions of this investment, so OpenAI was a not-for-profit when it was founded, and then as it raised at higher and higher valuations, it changed to a capped profit model where it was limited by the amount of money it could make. Part of the conditions of this investment from the UAE is it removes that cap and just becomes a normal for-profit company.
Makes sense.
Which seemed to always be where this was headed.
Yes. Yeah. Will this list, or will it go down the route of staying private for as long as possible?
Or will Microsoft try and buy it?
Swoop in. Unbelievable.
Why would you list if you could raise $10 billion at $150 billion valuation? Like, what, you just wouldn't need the headaches of being a public company.
No. No need. Anyway, we'll continue to watch this one closely. If you want to keep up with the headlines, make sure you subscribe to our daily newsletter. We'll send you headlines from around the world that we think are important when it comes to business and markets. We also send you questions that have come from the community and have been answered by our experts. So there's a link in the show notes and description to sign up. So Ren, resilience.
Yes.
Something we've been thinking about a lot lately, particularly, we've just spoken about the Aussie market being out of sync with what's going on in the rest of the world. There are plenty of reasons and causes for uncertainty. Inflation, cost of living, geopolitically, we've got Ukraine, we've got Israel, we've got Trump on the political side of things.
Yes.
Assassinated almost twice now.
I know.
Unbelievable. We've got the environment, we've got climate change, we've got AI, you name it. There are many reasons for which we can feel uneasy about what's going on in the world. So, Ren, this is a bit of a feel-good moment because when we're thinking about long-term investing, we love the resilience of stocks.
I'm not sure if you can set it up as there are so many reasons to be uncertain in the world and this is a feel-good moment.
Well, what we're about to say is feel-good.
I know what you're saying. We want things that are resilient, that can survive through
test of time,
chaos and whatever is thrown its way. And it was just something that we thought was worth reminding ourselves about, was just how resilient stocks are, but more importantly, why they're resilient. And the reason that they're resilient is because when you're investing in stocks, you're investing in companies. And all companies are collections of people working to solve problems and to manage the uncertainty before them. Unlike most other investments where, what you buy is what you sell and they're just subject to market forces. You buy a bar of gold, you sell a bar of gold. You buy a block of land, you sell a block of land. With companies, in some ways those investments are passive. You can do things, especially property. You can renovate, you can subdivide, you can develop in different ways. But really, at its core, what you buy is what you sell. Yeah. With a company, what you buy is what you sell in the sense that you buy a share and you sell a share. But what it is can fundamentally change because the people that are working there, they're trying to ride this uncertainty, they're trying to ride this chaos, they're trying to master the market forces, and they're trying to capitalize on them. And we've got some examples that we want to talk about because the story of the stock market is a story not just of climbing a wall of worry and a wall of uncertainty, but of capitalizing on it, of becoming, taking whatever the market and the world throws at these companies generation after generation and finding ways to get bigger and stronger and more resilient. And one thing that we're confident about is that story is going to continue to play out.
Absolutely. So if you've just started investing, as you said, Ren, we're not just buying shares, we are buying companies. And just think about what you're buying here. Thousands of people working on your behalf when you buy into Amazon, when you buy into Woolworths. I mean, Woolies has 200,000 people working day in, day out to make you money as a shareholder.
Yeah, and that's not like a throwaway line. Like, they are actually working to make you more money. And this is how. It starts with the board, who are elected by shareholders, and if they do a bad job, will be voted out by shareholders. So their incentive is to do right by shareholders. They appoint the CEO. They set the CEO's targets and the CEO's compensation, all of which are tied to shareholder return or things that drive shareholder return, i.e. revenue and profit and growth, etc. So the CEO's and the board's career and financial incentives are to make you as a shareholder more money.
Love it.
Then that flows down to the organization. Every employee who has goals set by their manager, those goals will be tied to company goals, which are to make shareholders more money. But then, every person who wants a pay rise, who wants a promotion, who wants that new opportunity, all of that is tied to achieving those company goals. And their incentive is to do things that drive company value, which drives shareholder value, which then leads to, gives them what they want personally. So it's not just a throwaway line. It is literally thousands, in some companies, millions of people working on your behalf to make you more money.
So good. And Ren, the best example of people working hard to make the shareholders money, and also what you buy is not what you sell in the instance of companies, is Amazon. Massive online giant. In 1997, it was an online bookseller with 256 employees and $15 million in sales. It was worth $438 million. Fast forward to 2020, it was not only a bookseller, but it was a massive e-commerce giant and web services provider with over 1 million employees and $280 billion in sales, worth $1.6 trillion.
Yeah.
Incredible transformation. Working for you.
Yeah, so from when it listed to 23 years later, it went from 438 million in value to 1.6 trillion. It's obviously continued to, grow its employee count and its sales count from there. But I think the important thing in this Amazon example, and to tie it back to where we started, resilience and uncertainty. Think about the uncertainty that Amazon navigated in that period of time. A few years after it listed, the tech bubble burst.
Yeah.
Amazon lost more than 90% of its value, shed employees. Everyone thought the internet was a fad, wouldn't have been able to raise any more money. It navigated through that uncertainty and came out the other side stronger. Then in America, less than a decade later, there was the global financial crisis. This was a unprofitable online retail business, and the consumers in America got absolutely punched in the face. It would have been completely understandable for it to not be able to navigate that time, but it navigated it, it came out stronger again, and it kept growing. And at the same time, there were all these people working hard to find new ways to drive shareholder value. Andy Jassy, who's now the CEO, was one of the main men behind starting Amazon Web Services, which is now like the main driver of Amazon's profitability.
Yeah, crazy.
It's the classic example of what you buy isn't what you sell, because no one who invested in 1997 bought Amazon
thinking it would be AWS.
Exactly.
Yeah.
There is no way you could have foreseen that. But that is just like why stocks are resilient and why we love them, because you get the application of human ingenuity, of thousands of people's best ideas and best efforts to make you more money. That is why we love stocks, and that is why we love investing.
Well, if that doesn't get you pumped enough to keep investing, or at least start investing if you're sitting on the sidelines wondering if it's for you, then I'm not sure what else we can do.
Well, we'll keep trying.
We'll keep trying, yes. We will keep rinsing and repeating that message. Now, stick around. We're going to take a quick break, but on the other side, something that we have never done on the podcast. Admittedly, we have done it in live form, but on the podcast, we have never revealed every single position in our portfolios, and Ren is about to do that.
Don't know why it's just me. I don't know why it's just me.
Anywhere. Don't go anywhere. We will be right back. Welcome back to Equity Mates. Now, this is a segment that I think many of you at home have been waiting for so long. Ren's going to reveal his portfolio. How this came about was, if you're not in our Facebook community group, get in there, because it seems like you can influence what happens on the show.
Yeah, you can definitely influence what happens on the show.
You can definitely influence what happens on the show.
I just thought I could also influence it. I guess not.
One of our community members, Tony, he put up a suggestion that if there are 100 likes on a particular post, that Ren would have to reveal his portfolio. And lo and behold, there are over 100 likes, Ren. So let's start with the structure of your portfolio.
Okay, so we talk about core and satellite on the podcast. We recently did an episode on our sister podcast, Get Started Investing, about core and satellite. I have core and satellite with, I guess, a little twist. So I sort of split my portfolio into 3 segments.
Okay.
Core, then active and thematic, and then satellite, which is individual stocks.
Nice. All right. So
I can talk to the philosophy of that, or we can just get to the...
that's a good starting point. Okay. Now, we're not here to talk high level, though. We need to get into the nitty gritty. So talk us through your core holdings.
Yeah. So for me, when I think of core, I think of like the truly long-term bottom drawer set and forget. And for me, the only investment that fits that bill, I should be very clear, for me, the only one that fits that bill are market cap weighted index ETFs.
Yes, okay.
And so rather than doing a all-world ETF, like a VGS or a DHHF or a VDHG. I guess, the ability to set my own portfolio weightings. And so I have 5 ETFs that make up my core portfolio.
Okay.
They are in no particular order because they're all equal sized. Vanguard Australian Shares, VAS, iShares S&P 500, which is the US, Vanguard FTSE Asia ex Japan, which is Asia, BetaShares Europe, and then BetaShares FTSE 100, which is the UK.
Nice.
So for me, that gives me a pretty much most of the world.
Yeah.
Yeah.
Nice. So 5 core. Let's move on to the...
No questions? No follow-up?
Well, I mean, they all make sense. We've spoken about this part. I think of all parts of the portfolio.
True.
This is a part of the portfolio that I think we've covered the most. And so let's move on to the, I guess, more interesting elements, which is what you defined as your middle part of the portfolio, that intersection between core and satellite. And this is where you start playing around with active management and thematic. So talk to us about that.
Yeah, so why I think there's sort of middle ground. I don't think active managers or thematic can be truly long-term set and forget investments. You need to be checking in on them and thinking about them. Like they're just not built in the same way that index products are built, which is perfectly fine, but it's just, I think of them as a separate bucket.
Yeah.
So I've got, we've spoken about NAB Equity Builder. We probably haven't spoken about it for a while. So for people that aren't familiar with this product, it's the only investment loan we've come across in Australia. There might be others, but it's the only one we've come across that is set up like a mortgage where you have principal and interest payments rather than a margin loan structure where you can get margin called. And so a couple of my active managers are through that product. And so the investment, I'm limited by NAB's investment menu.
The reason, I think, to shine a bit of light on that, the reason we did it was because at the time we used it to be able to borrow the minimums required to get into these active managed funds,
and also interest rates
were ridiculously
we're paying
low.
like 3 or 4% on that loan, and your expected return, call it 8%.
Well, even with dividends on some of them, you were well and truly making that back.
Yeah. So now the maths doesn't work quite as well.
No,
but I'm in it, and it still is working. So I've got 4 active managers, some through NAB, some separate. Hyperion, Global Growth, Alphinity, Global Equities, Fairlight, small companies, and then Munro, Global Growth. So really, I like quite growth focused, obviously, but that's where my risk tolerance is and my interest. And the privileged position we have being on this podcast is we've interviewed all 4 of managers from these funds, and I was impressed by them all. So
yeah, I agree. All impressive. Is there overlap between them? Because you could look at all 3 and say they're all global growth.
Yeah.
Are they investing in the same things, or you just love the managers? Like, what's the...
There's some overlap, but not enough that I am worried.
Nice. Performance on some of those over the last 12 months has been pretty incredible as well. So those are the 4 active. You've got a couple of thematics in there as well.
Yeah. Now, in general, I don't like thematic ETFs. Just like as a general rule, I have to be pretty convinced by them to get into them.
Yeah.
One that I do like, though, is the BetaShares Global Cybersecurity ETF. Just because I think the structural tailwinds for the industry are truly long-term, and I have no way of picking what the best cybersecurity players in the market are. But governments, companies, individuals are spending more and more each year on cybersecurity as a sector. The value continues to go to the biggest players in the sector. So like the thematic ETF kind of makes sense there. So I've had that for ages and just keeps ticking away. I also bought some Global X Semiconductor ETF. In hindsight, the more sensible choice would have just be to buy NVIDIA.
Yeah, I'm the same. We got that feedback. Well, I think I got that feedback from Luke when we did the Pimp My Portfolio, because he said the same thing. If you're buying that ETF, you're buying NVIDIA.
Yeah.
Where NVIDIA goes, that ETF goes.
But the challenge is hindsight is easy.
Definitely.
So if we look at those 2 sectors, cybersecurity and semiconductors, you could have had similar reasoning for both. The sector is growing, there's long-term tailwinds, there's more spending every year. The difference is NVIDIA had this technology that was just, like, no one was getting close to it, and no one's really caught up to it in the years since it's exploded. But that could be the same with global cybersecurity as well. Like, I don't know enough to know if like Palo Alto Networks has created something that will make them like an outsized winner in the field. So yeah, hindsight's easy.
I kind of think about it differently. It's probably, for me, it's probably a mistake now to continue owning it because of the weighting of NVIDIA in there. But at the time that we bought it, NVIDIA wasn't it wasn't taking up as much of the index as it is now, if that makes sense.
Yeah, but that's why we should have bought NVIDIA, because it hadn't had its explosive growth yet.
Yeah, but as you said, like at the time, we didn't know which one of those. You know what I mean?
Yeah.
So anyway, that's good. So that covers off your active, thematic, and core. Now let's get to your satellite. So you've got 14 stocks in your satellite.
Yeah.
Talk us through them.
So I'll just read them out as a list to start with.
Why don't you just read your bottom positions and just give us a one-liner on what they do?
Okay. Hit IQ, Specky.
Yes. That's not what it does, but yes.
Mouthguard technology to measure head impact related to concussions. Jumia, Africa's emerging super app, potentially. Dia, Internet of Things in agriculture. C Limited, Asia's emerging super app, or Southeast Asia's emerging super app, hopefully. BHP, Australian mining giant, not doing too well recently, but a lot of green metal potential over time. ResMed, the sleep apnea story, we can talk about that more later. Spotify, it's just been a mainstay for a while. Everyone knows it. MinRes, we spoke about earlier. WiseTech Global, the underrated Australian company. Well, maybe
I don't think it's underrated
fairly
anymore.
rated now. It was underrated when I got it, but aggregating on one platform the fragmented global shipping and logistics industry.
Yep.
Novo Nordisk, miracle weight loss drugs.
Nice. Okay, so that's 10. We've got 4 to go. Some of the more high conviction ones, I would say. What have you got?
Oh, yeah, I guess.
Well, one is. So we've got what comes in number 4?
Cochlear, Australian hearing device maker, one of the best moats in the game, I would say. Shopify, the e-commerce giant, backbone of the internet's economy.
Yeah.
Along with Stripe. Guzman y Gomez, that was where I was like, conviction. I mean, I'm probably not comfortable at being my second biggest position, but got in on the IPO and it's grown since then.
Yeah,
so
can't complain.
I'm certainly not complaining. And then my biggest position is an American company, Axon Enterprise. This was my stock of the year last year, so I've spoken about it for a little while, but it's probably less known than a lot of those other names. Started out making tasers. That's not why I like it, though. Why I like it is the body cams for police and security, but also the platform, evidence.com, where all that gets uploaded to. It is a sticky moat. It's founder-led, and God, it's been good.
Nice. So that's the breakdown. Now, in terms, if you're sitting there wondering how weighting and all this sort of stuff, I think for Ren, between your core, active, and thematic, it's about 65%. And then between your individual stocks, it takes up the remaining 35% or thereabouts. So there you have it.
I feel super vulnerable. No,
I think there's some really interesting stuff in there. I think if I look at the stocks as well, a decent mix globally, you can see which ones you've got sort of hit IQ. We've done that on the show.
That's 1% of the portfolio. Let's be clear.
Yeah. No, I think an interesting mix of active and thematic as well. So, but I think at the end of the day, if you can just shine a light on how you, which we've done on the show before, but how do you actually allocate cash to this portfolio?
Yeah, it's a good call. So the core, those 5 ETFs are an automated part of my fortnightly pay cycle. We get paid on a Monday here at Equity Mates. On Tuesday, there's an automatic transfer to a broker, and then on Wednesday, that automatically invests evenly across those 5 ETFs.
Yeah.
So that's just going all the time. The active and thematic stuff, I'm not adding more to. It's just I've got a position there, and maybe I will in future, but it's not something I want to regularly contribute to. I just want it to tick away. And then the individual stocks is purely opportunistically. So the last one I bought, I bought some more ResMed after the Apple announcement, which we spoke about on the podcast a couple of episodes ago. But yeah, there's no automated or regimented way I'm allocating to my individual stocks. It's just as and when opportunity arises.
Nice. Well, thank you for doing that, and thank you for Tony for striking up support in the Facebook group. If you're listening and you're not part of it, we'd love for you to come and join our Facebook community, because there is so much happening in there, plenty of conversation. We really appreciate it and love the chit chat.
So, I mean, the obvious question that comes out of this is, when are you going to do yours?
Well, I've got to see it in Facebook.
Okay. All right.
I've got to see the support.
Bryce wants to be asked. Everyone jump over to the Facebook group. We'll get the 100 likes, because if I'm going to step out, and I will honestly be interested to hear the critique. Like, it might actually lead to a much better portfolio if people give me some feedback and say, you're an idiot for doing this.
I don't think that will happen, and I think...
maybe.
I don't think so.
Maybe.
Who knows? Anyway, we're going to leave it there. Thank you so much for listening. A reminder, if you want to sign up to our daily newsletter, there is a link in the show notes, as well as a link to our Facebook discussion group to join the conversation. And if you've enjoyed the show or you take a lot of value out of it, please, if you could leave us a rating and review in your podcast app. It won't take you more than 1 minute. We would really appreciate it. Ren, as always, lovely to chat, and we'll pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.